Hello and welcome to the Mutual Fund Guide. It's all about your funds and your returns. I'm Muralidhar Swaminathan. In this show, we focus on the impact of dividend tax on mutual funds and the long-term capital gains tax on equities. Of course, this entire setup is in the backdrop of a sharp fall in the markets over the last 2-3 days. Where do we go? How do we invest? Would you want to stay invested? Will your mutual fund investments be affected by the LTCG tax, by the dividend tax? To answer all those questions, we have with us two mutual fund experts, Hemant Rustagi and Pankaj Matpal. Thanks, gentlemen, for joining us. The setup, as you know, is something which nobody would have liked. You know, the run was uninterrupted, everyone was putting in money. First, Pankaj, I would like to come to you. Do you think the two taxes, the tax on dividend and the long-term capital gains tax, will affect inflows into mutual funds?
See, yes, initially investor will take it negatively, and we have even seen that initially, but the fact is that because equity as an asset class is a part of a portfolio, and if you are planning for long-term goals, then there has to be equity in your portfolio. So whether you tax it or tax is not there, people will invest. But yes, initially it is negative. People have not accepted it, and sentiments are negative. So going forward, I expect that people will continue investing, and even I think that they should invest in equity or equity-oriented mutual funds. But what has happened, it was not expected. And still, if you see, retail participation is not so great in equity. So it was an incentive for them that returns were tax-free. So now when your returns are taxable, then definitely not a good thing for any investor. But if you think about your goals, I think that they should continue investing in it.
Right. Hemant, do you think people who have been subscribing to dividend plans, should they move to growth plans to take advantage and save that 10% tax on dividend?
It does not matter actually. Both dividend option as well as growth option is basically taxed at 10%.
Right.
Obviously, you need to look at your own scenarios to when did you invest, whether the gain which are there is long-term capital gain or short-term capital gain. But the fact is that either which way, you have to pay 10%. So clearly, whether you're going for growth or for dividend should be based on what exactly you want to achieve from your investment.
Right.
So if you're looking for building capital over a period of time and you want to benefit from power of compounding, obviously growth option is the best for you. But there are investors who want regular income, and there are also investors in equity who would like to systematically book some profits.
Correct.
Because booking profit is basically nothing but timing the market.
Exactly.
So many people struggle as to what is the right time. So the
yeah.
best thing is leave it to the fund manager.
Yeah.
Once in a year, and some fund maybe twice a year, he will give you the dividend. So rather than you trying to time it, you get it. So if you're looking to book profit regularly, if you're looking for some regular income in addition to the growth that comes to you, then I think the key criteria should remain as to what your requirement is.
So is there an escape route in offering bonus units?
Not really, but I think we don't have bonus units anymore in the mutual funds.
Right.
So there is no question of...
There's no question of... it's not allowed by regulation, or...?
Well, I think if I remember correctly, yes, I think it's not allowed.
It's not allowed. It used to be the case earlier. Now anyway, okay. So the other question, Pankaj, let me come to you. So now if an investor is in dividend plan, he or she has to pay tax on dividend, but also when they redeem, there will be capital gains at some stage. So they will take knock on both. Also put it in perspective, dividend, long-term capital gains are exempted up to 1 lakh. So to that extent, how should they plan there?
See, first thing, dividend distribution tax is applicable on the mutual fund. It is adjusted in the NAV. So it's not that once it comes to you, then you pay tax on that.
Right.
It is adjusted in the NAV itself.
Right.
So in any case, if any dividend is paid to you without any cap, that is taxable. When we talk about the long-term capital gain tax, that is applicable only when that gain exceeds 1 lakh rupees.
Right.
So one thing is that if you don't need the liquidity, it is better to stay in the growth plan only. Second thing, if you think that your profit is 1 lakh, of course, churning may not be a very good thing, but if you really want to reduce your tax burden, that can be one strategy, that when your profit is like 1 lakh rupee, you book your profit and again reinvest.
Right.
So up to 1 lakh profit, because that is tax free in a year. So if you're investing for 5 years also, for example, and if you invest in this year and after 5 years you redeem it, in 5 years the gain is higher. Right. But every year you are booking that 1 lakh profit and redeeming it. Assuming that tax law is same in the subsequent years as well. Right. In that case, it may be a strategy that you book your profit to the extent of 1 lakh rupee every year. Right. So it becomes tax-free for you, and going forward, that tax burden is lesser.
Absolutely.
Just want to add something to this. I think you asked a very important question. I think very important from the investor's point of view. The issue is that, if you book profit of 1 lakh, for example, you may save a tax of, let's say, 10,000 rupees because 10% is what you're paying. There is always going to be a gap. Even if you switch from one fund to another fund, it will take 3 days from equity to equity, suppose you're doing. And in the process, market goes up by 2%. Okay, so let's say if you have an investment of 4 lakh, you made a profit of 1 lakh, so you're redeeming 5 lakh basically to save that. If the market goes up by 2-3%, it can happen sometime in the market. Exactly. So you save 10,000 and you actually end up entering at 15,000 higher again. So I think you need to be very careful.
Timing is not not a good idea. The other important, in the current context of the markets, seeing wild and sharp cuts, following the global markets, of course. On the broader indices like Nifty and Sensex, we have seen 6 to 7% cut, going up to even 10% in some cases. But at the small cap and mid cap level, the cuts must have been very, very sharp. So what do mutual fund investors who are stuck in small cap and mid cap funds do?
First thing, I think every mutual fund investor needs to remember one thing. Volatility is a natural phenomenon in the market, and you need to be always prepared for that. Now, what typically happens, the kind of run we have seen in the market, people get carried away by looking at last 1 year or 2 year performance. So obviously, in a scenario like this, the sector fund, thematic fund, mid cap, small cap funds have done much better than large cap oriented fund or multi cap fund. So clearly, I think the fall is much, much more. And then suddenly you are faced with the reality that yes, this is the risk which is associated with investing in a fund like this. So I think it's important that this is the right time, I believe, that investors should go back to the drawing board, look at the composition of funds in their portfolio, and if they got carried away at some stage, that they've kind of increased their exposure to mid cap and small cap to the extent which takes them beyond their risk-taking capacity. I think this is the time to kind of realign that. So it's very, very important because always need to remember that one, asset allocation in terms of how much you allocate to equity, and the second is you need to look at within equity, each segment, how much exposure should you have. My belief always is for a long-term regular investor, normal investor or a retail investor, 60% should be in large cap, 40% should be in mid cap and small cap.
Yeah, and I think in the current market, if you look at all the blue chips and large caps, they've all been down by 5 to 6% on an average. This must be a great time to look at large cap funds, I suppose.
Oh, absolutely.
Right. Okay, I think we have a caller. Prashant is on the line from Mumbai. Prashant, what's your query?
Okay, so my query is regarding the long-term capital gain tax. So when I invest to the mutual funds, and I want to understand that when the mutual funds or the AMC companies, when they do the transaction on the behalf of retail investor, are they need to pay the tax, the same LTCG tax? So what I understand is if the AMC transactions are going to attract the tax, then in that case is going to be a double taxation for the retail investor.
Pankaj, you want to answer that question?
Yes, see, long-term capital gain tax that investor has to pay, AMC is not paying that. So whatever the long-term capital gain is there, on that you have to pay 10% tax. As far as dividend is concerned, on dividend, AMC will pay the tax on the dividend distributed, and that will be adjusted in NAV. So that in the hand of investor, dividend is tax-free, you are not paying. So there is no double taxation as far as dividend distribution tax is concerned or long-term capital gain tax is concerned. But yes, security transaction tax is one thing which you pay at the time of redemption.
All right, Prashant, hope that answers your question.
Yeah, pretty much.
Okay, so that's very clear. That's the kind of doubts people have after this taxes have been imposed. Yeah, so we have one more query coming from Ahmedabad. This is in the form of a mail. Mohit Gupta from Ahmedabad has emailed us this query. He wants to invest in IDFC Balance Fund, Invesco India Dynamic Equity Fund for long-term period. What's your recommendation, Hemant?
Well, I think again, as a category, one has to really see, because if you're looking at dynamic asset allocation fund, again, a good option for someone who can't decide how much should go into and what level to go into. And even in the balance fund, again, 65% plus goes into equity and the rest goes into debt. So clearly, first, I think the option itself should depend upon what your requirements are. Within that, there are a number of funds. These are two funds. Obviously, there are many other funds like Reliance Balance Fund, which has been doing very well. HDFC Prudence has been doing very well.
Yeah.
So those are the options one can look at. But I think from investors' point of view, like I said, the first thing they need to decide how much allocation they want to do.
Right.
So dynamic asset allocation fund is good for someone who's not very sure as to how much should go and when they should come out. So I think that's clearly something that investors need to look at.
Right. We also have a query from Bellary in Karnataka. Muralidhar is on the line. Go ahead, Muralidhar. What's your query?
Hello, Raman sir. Sir, I hold UTI MNC fund and Reliance Top 200 fund. Can I hold it? Is it worth to hold or can I change?
Right. Pankaj, you would like to answer? Yeah, go on.
One more query, sir.
Yeah.
Sir, regarding long-term gain, capital gains in this new budget, what is the preference? Shall I hold it for 2-3 years or shall I sell it within a year? What is the difference in?
Important question, Pankaj, again.
See, the most important, what is your goal? If you are a long-term investor, you have invested for a long-term goal, then definitely you should stay invested only. And when you invest in equity, first thing that you have to keep in mind that equity is, as an asset class, is for long-term only. So definitely you stay invested. And as far as funds are concerned, again, you have invested, these funds are good, definitely. But again, in your portfolio, there should be mid-cap and large cap. As earlier also Mr. Hemant said that 60% allocation equity, large cap, and 40% mid cap. That is the good allocation when you are planning to invest for long term. So in that way, a little bit rebalancing of your portfolio is required. Otherwise, funds what you hold are good.
Okay, Muralidhar, see, basically, you should not worry too much about the long-term capital gains tax. You know, as our friend suggested here, you should, if your objective is long-term and you want to create wealth, I think you need to stay, and over a period of time you will find that your returns are far more than the capital gains tax that you would be losing. Is that clear? You want to follow up with any question?
Yeah, because I always keep it long-term, because the recent budget has shown that the long-term taxes are being done.
Yeah.
Will it affect my, that is the question, will it affect my earnings?
Okay, I will let Hemant. Pankaj, you want to continue?
I just want to say something. See, I agree, when your returns were tax-free and now it's taxable, definitely your returns in your hand are lesser than what you were expecting earlier. But just compare with your fixed deposit or any other saving instrument. See, if your fixed deposit tax at 30%, then also you are investing in that, or I mean, investors regularly invest in fixed deposit kind of schemes. So if the 10% tax has been introduced and your returns are still good, then I think there is no need to worry about that. So equity must be in your portfolio as an asset class. For different goals, you have to allocate between debt and equity, and even for that sake, a small allocation maybe in gold also. So asset allocation is important. I agree with you, the 10% is something hurting to the investors. At the same time, just compare with the other schemes available in the market, 10% is still lesser than 30%.
Absolutely. Yeah, I hope that's very clear. At this stage, let's slip into a short break. We'll come back and take some more questions from our viewers. Stay tuned. Welcome back. You are watching Mutual Fund Guide on Business Television India. We have been discussing about the mutual fund tax, the tax on dividend and the tax on long-term capital gains. We have some more queries coming in. Narendra Kale is on the line from Udaipur. Narendra, go ahead. What's your query?
Yeah, okay. I want to ask two questions on dividend tax. In fact, is there any exemption of rupees 1 lakh on tax on dividend from mutual funds? Number one. And number two, if that is there, how to claim that money back, because they'll be deducting 10% and giving you the dividend.
Right. Hemant, you want to answer this?
Yes, I mean, let me just clarify here that the exemption of 1 lakh that you mentioned is basically on the long-term capital gain. as far as the dividend from equity fund or equity-oriented funds are concerned, let me explain that there are all three categories: equity saving, balance, and all equity funds are included in that. There is a dividend distribution tax of 10% which has to be paid by the mutual fund. So any dividend that comes in your hand will be tax-free. This 1 lakh exemption is on the long-term capital gain and not on the dividend. So there is no question of you claiming any refund from the tax authorities.
Right. So I think there are many queries. Narendraji, I hope that answers your query.
Yeah. Okay. So that means there is no exemption of 1 lakh if I receive 1 lakh as dividend.
No, not on dividend, not on dividend.
So there is nothing new as such. Only in equity it has been introduced.
Yeah.
Otherwise, dividend distribution tax was already there in debt-oriented mutual funds.
Okay, I think we have one more caller from Chandigarh now. Yashpal Gupta is on the line. Yashpal, what's your call?
Hi sir, I'm Yashpal Gupta. Sir, in fact, I'm senior citizen, retired from an insurance company.
Yes, sir. Go ahead.
Sir, in fact, I have my, in fact, I have invested my retired corpse. Out of that, 50% in bank FDR and senior citizen savings schemes.
Right.
40% in very good balance funds like ABCL balanced 95, HDFC balanced and IC Prudential balanced fund.
Right.
And 10% kept in pure equity, just say IC Prudential Dynamic Plan and ELSS. Sir, my query is whether in fact the funds kept in ultra short-term funds are giving very nominal returns.
Okay.
They are not matching even Yes Bank saving rate of 6%.
Right.
In fact, I wanted to kept some money, say around 10% for switching to balance funds.
Right. I think that's a very interesting query. I think his allocation is very interesting. Pankaj, would you like to answer this?
See, because you are a retired person, allocation also correct that you have allocated some amount in equity, which will help you getting inflation adjusted returns. So it's a good strategy. Now allocation wise, you have to see many more things also, that because you said 50% in balance fund and then also in direct equity funds. So maybe allocation may be a bit higher. So you have to think your risk appetite and the time horizon for this investment. Allocation maybe time to time you can adjust also. Otherwise, it is good to have allocation different asset classes. Other question was very important. You said that short-term funds, where you are not getting returns even, or returns are not matching the bank's saving bank returns, interest rate. See, I expect because last year you are comparing with the previous year, there was interest rate cut in the last year, and you could not expect good returns in this. But going forward, I don't foresee the rate cut now, and even we can expect the rise in rate.
Yeah, exactly. You know, see, that's the trick in the debt funds. You know, whenever you go to debt side of the fund, when yields keep going up, your returns will go down. So we are in a market where bond yields are going up. The expectation is that interest rates will go up. So therefore, your holding will take a cut. Hemant, you want to?
Yeah, only for him, basically, I think he's referring more to the ultra short-term fund.
Ultra short-term, yeah.
Because he's comparing that with saving bank account.
Yeah.
Now, obviously, what has happened in the last 1 month or so, we've seen the returns of that even getting impacted. Coming to around 4.5%.
Exactly.
So he's right in that sense. But traditionally, if you look at ultra short-term fund, they give you higher return than saving bank account. And another important aspect is also your nominal tax rate. So if you're not paying any tax or in 10%, and if you're getting the same amount of return from bank as well as mutual fund, so it's not necessary that you have to be investing in mutual fund.
Exactly.
You know, bank can be a great option.
Yeah, I think bank FDs would be a great option in that case.
So clearly, if you're not paying tax or you're paying only 10% tax, then obviously you should be looking at something which is more suitable to you rather than going into something, because even the ultra short term fund is a market linked product. So even though it's investing for up to 90-day security, you can still have some kind of volatility over there. So I think it's important for you to look at what your requirements are.
Good to know, Yashpalji, you have a good mix of FDs and debt funds and balance funds and equity. Okay, we have one more query coming. Shanti Ghosh from Hyderabad has emailed us this query. He has two questions. He has invested in Aditya Birla Sun Life Balance 95, ICICI Pru Nifty Next 50 Index, SBI Magnum Balanced, Kotak Opportunities and L&T India Prudence Fund. Wants to know what would be the outlook for these funds, Pankaj?
See, all the funds are good. You have allocation in balance fund. and as well as your large cap funds. So you can continue these funds. But again, the thing is that if investor tells this thing that how much is the time horizon, what is their goal, it becomes easier, because earlier also we have discussed this thing that asset allocation is important. Within asset class also it is important that how much in large cap, how much in mid cap or multi cap. So just if you ask about the scheme, then definitely if you see the performance, if you see the strategy of the scheme, this is a good scheme. But if you want that, are they good for your kind of goals, what you're planning to achieve out of this, then definitely there should be something more than this.
Right. The second part of the question is a little more aspirational. I also want to invest 15 lakhs for a long-term period. His investment objectives are to get tax exemption and travel abroad. Hemant.
Well, I think, it's always good to follow a goal-based investment process, because what you do in that case is you define your goal, you know how much time horizon you have. That also allows you to, kind of decide your asset allocation. So clearly, if it is for, for traveling, if it is going to be regular travel, obviously there's going to be time gaps every 2 years, 3 years. So that becomes your time horizon. Yeah. So any goal will have a time horizon, and based on that, your asset allocation should be decided. So where you need money for the short term, for example, let's say you need money every 3 years, you can take some amount of risk. We just mentioned about equity saving fund, or maybe in some cases balance fund. That kind of mix can be looked at. So the key factor is, when you invest for the long term, invest to beat inflation. When you invest for the short term, your focus has to be on capital protection. When you invest for the medium term, it has to be both capital protection as well as growth. So I think that should be the guiding factor for any investor.
But very important, when you say 15 years and goal is also going on vacation. So I think that equity is something which should be on the higher allocation in your portfolio.
Absolutely.
Isn't it? Because when you say that long-term goal 15 years and that also the vacation planning something.
Or maybe he's trying to do a world tour over the next 15 years.
Absolutely. I think sometimes wealth creation helps, people can enjoy the benefits. We have one more caller, and this call is coming from Mumbai. Thakkar is on the line. Go ahead, what's your query?
Hello.
Hello, yes, please go ahead.
My question, I told him that what is the effect of the long-term capital gain tax in mutual funds?
Right. Yeah, I think the same question is coming again. It's a very important question.
So, see, when 10% tax is there on your long-term capital gain, then your returns, whatever you get, it is reduced by 10%. Simple thing. But again, now what has happened, that is there. Important is that equity must be allocated in your portfolio, and you must invest in that to achieve your financial goals. And when you're comparing this 10% tax, always think that you are paying up to 30% tax on your fixed deposit. So that is why by just this sentiment that 10% tax has been introduced, do not ignore equity in your portfolio.
Can I just add something here?
Yeah.
I think two important things. One is the long-term capital gain is applicable from 1st April. First thing is very important for investors to know that.
Yeah.
The second is that your gain that accrued till 31st of Jan have been grandfathered, in the sense they have been protected. So that is going to be a deemed cost. So if you redeem within next 2 months, let's say February and March, there is no capital gain tax at all. But if you redeem after 1st of April, then there are different permutation combinations that will apply. So I think it's important to know that it's applicable from 1st of April. And whatever gains have accrued till 31st of Jan will not be taxed.
Will not. So therefore, that's important for people who are actually booking profits or getting out of redeeming their units now. The point I would like to add here, Pankaj, Hemant, is that over a longer term, if the investor does not want to redeem anything and hold on for a longer period, I think the chances are that there will be some rationalization that will come in the tax regime going forward. See, there is also a direct taxes panel which is working on all the details. They might look at different asset classes, see how taxes are panning out, see the difference between the short-term capital gains and the long-term capital gains, which is only 5% now. Short-term capital gains is at 15% and long-term is 10. So some stage I see some rationalization coming, and investors who are holding for a very long time should not panic.
No, I think it's very important for everyone to understand. Yes, there is a long-term capital gain of 10%. It does not take away the potential of equity as an asset class.
Exactly.
The fact remains that equity have been giving higher return. Equity will continue to give higher return. Second, as I mentioned earlier, volatility is a natural phenomenon in the stock market. So anyone who is investing should be ready for volatility coming in any form. So as long as you remember these two, that your returns are going to be higher over a longer period. So it's very important that look at your asset allocation, look at your time horizon, go for it when you're trying to beat inflation over a longer period. Absolutely. So it does not matter. Like it will take away 10% of your return, fine. But as you mentioned very correctly, some kind of rationalization has to happen over a period of time. And if one has to pay tax, one has to live with it. What you need to see is whether equity has a role to play in my portfolio or not. Very much. It does not take away the potential of whenever you're investing for the long term.
Very clear.
Though we didn't get any question today about the SIP, like people have been investing in SIP for long
that's
term,
a very important question.
And then how did tax? So simply because when you invest in SIP, each SIP installment is considered as a fresh purchase.
Fresh purchase at a fresh cost,
Fresh cost. So in that case, means all the units which have completed 1 year will only qualify for the long term capital gain. Second thing, units bought before 31st January. Before up to 31st January 2018, so that will be priced at the NAV of 31st January. So whatever the rate was there earlier, when you redeem those units after 31st March, you have to see the cost as the NAV of 31st January 2018. So definitely means that grandfathering godfathering clause what you have got, that is definitely good for investors. At least whatever they've invested earlier, considering that your returns will not be taxable, so those returns are still not taxable.
Right. Okay. I think very clear analysis and advice coming from our experts. Pankaj, Hemant, thanks so much for joining us. With that, it's a wrap on this edition of the Mutual Fund Guide, but we'll be back next week to answer all your mutual fund queries. News and updates continue on the other side of the break. Keep watching Btvi.